Housing affordability has just improved as interest rates have moved down. So how much home can you actually afford in today's market? In this video, I'm going to be walking you through a couple of different scenarios, whether you make $50,000 a year, $75,000 a year, or $100,000 a year. When you leave this video, you're going to know exactly how much home you can afford using an FHA loan. The reason we're using FHA is because FHA is the most lenient loan program out there. It allows you to qualify for the most home with the least amount out of your pocket, while also having lower credit scores. But something to keep in mind, this loan program isn't just for those with low down payments and lower credit scores. It can be used by anybody, whether you're a first-time home buyer or somebody buying multiple homes with great credit and a large down payment. So with that said, this is an educational video, something to walk you through the scenario of those different incomes. But don't take these incomes and just run out and try to buy a house. Make sure you're working with a professional. Have them run over the numbers with you, verify the information that you're putting in, your income, your credit, all of that stuff, just to make sure you have accurate information. If you're not sure where to start, my team and I help a lot of people here on YouTube. We've helped hundreds, and we'd love to help you too. You can get in touch with us using that link in the description of the video. So how does a lender determine how much home you can actually afford? Well, there's something called a debt to income ratio, and that's what a lender uses to determine how much home you can actually qualify to buy. Now, in order to calculate the debt to income ratio, you have to know how much money you make per year. Now, if you're a W-2 employee, you receive a paycheck every single week, it's a pretty easy calculation. You just take your annual salary and you divide it by 12, and that's going to give you your monthly income. But here's the thing, if you're self-employed, you receive 1099, you drive for Uber or DoorDash, and you get checks that are sporadic and they're not always the same, this is a more difficult calculation, and this is going to be harder to do in today's video. I would recommend, if you're in that scenario, make sure you're talking to a professional. Let them calculate your income to determine exactly what income to use. But in today's video, we're going to be talking about a $50,000 salary. We're going to be talking about a $75,000 salary, as well as a $100,000 salary. So in the case of a $50,000 salary, what we do is we divide that by 12, which is going to break down to an income of $4,166 per month. For the $75,000 income, that's going to be $6,250 a month. And for the $100,000 income, that's going to be $8,333 a month. So now that we have those monthly salaries, we need to know how much the lender is going to allow us to use towards our monthly housing expense. That's our debt to income ratio. Now, when it comes to debt to income ratio, there's a front end ratio and a back end ratio. The front end ratio is just the housing expenses. It's the mortgage payment, it's the property taxes, it's the mortgage insurance, the homeowner's insurance, if the property has a homeowner's association fee. It's all of that calculated as a total payment divided into that salary we just discussed. Now, it doesn't include things like your utility bills. It doesn't include things like your gas bills or any of those other payments. It's just the mortgage payment, the property taxes, the insurance, the HOA dues, that sort of thing. But in the case of FHA, they allow you to use 47% of your monthly income before any taxes towards your housing expenses. So in the case of a $50,000 salary, that front end ratio is going to be $1,958 because that's 47% of $4,167. Now that's how the front end ratio works. There's also something called a back end ratio. The back end ratio is all of those housing expenses that we just calculated, plus your monthly debts, things that show up on your credit report. These are things like your car payments, your credit cards, your installment loans, any type of loan that you had to give credit in order to get, and it shows up on your credit report. Those things are added to your back end ratio. And what this doesn't include is things like your groceries, your cell phone payment, how much you pay in childcare, or how much you pay to go out on date night. Yes, all of those things should be factored into your monthly budget, but the lender is not using them in order to calculate how much home you can afford. They're only using the things that show up on your credit report. And FHA allows you to go to a 57 back end ratio, which means 57% of that take-home pay before any taxes can be used to help you qualify for a home. It's going to include all of those housing expenses plus your monthly debts. Now, the thing to understand here is that that housing expense can't exceed 47% of whatever that monthly income is. Now, a lot of people say, well, Jeb, why are the lenders allowing me to use my income before any taxes come out? Because that's not actually what I take home. I take home a lot less because I'm paying taxes. I'm paying money into a 401k. I'm paying money into some sort of deferred comp. So I'm actually bringing home a lot less than they're allowing me to use towards my qualification. And that's because everybody does a different factor or a different deduction when it comes to their income, right? Some people are claiming exemptions on their take-home pay. Some people aren't. Some people are paying into a 401k. Some people aren't. So the easiest calculation for the lender is to use your gross monthly income before any taxes come out. And this in turn also allows you to qualify for more home, because if they were using your take-home pay, you would be qualifying for a lot less. Now, just because FHA allows you to go up to a 47% front-end ratio and a 57% back-end ratio doesn't mean you should do it, right? You should have the budget that we discussed earlier so that you know exactly how much home you can afford. So even if a lender tells you, hey, you qualify for this amount, you might not be comfortable with that amount. You need to know how much you're actually comfortable with so that you're not putting yourself in a risky situation. So now that we understand that, I want to take a minute here and ask a favor. If you find any value in my videos at all, make sure you hit that thumbs up and consider subscribing to the channel. And if you need someone to guide you through this process, make sure you use that link in the description and you can speak directly with my team. So now I want to take a step back and talk about the $50,000 income, the $75,000 income, and the $100,000 income. We're going to talk about the qualification there, and then we're going to translate it into exactly how much home you can afford to purchase. But when we're talking about a $50,000 salary, remember that breaks down to $4,167 a month. Now, the max housing expense we can have on that is $1,958, but that's just the front end ratio. Now, the back end ratio allows you to go to $2,375, which means if you maxed out that front end ratio, you could have about $417 in monthly debt and still qualify for the same home. Now, if you have more monthly debt, then you're going to have to qualify for less home so that your back-end ratio doesn't exceed that 57%. But for today's video, we're primarily going to focus just on the front-end ratio to see how much home you can afford if you didn't have any debt. Now, if you have debts, you definitely need to talk to a mortgage professional, let them run through the numbers, but it's very, very difficult to calculate that because everybody has different debt. Some people have no debt, some people have a lot of debt. But in order to make this video flow, we're just going to assume you don't have debts. I'm going to tell you, hey, this is the max front end ratio, but you could have this much debt and still qualify for that same home. So hopefully that makes sense. But if it doesn't, make sure you leave a comment in the description of the video and I'll go back and try to help you understand it. Now, when it comes to our $75,000 salary, once we break that down monthly, that comes out to $6,250 a month. Now, 47% of that is $2,937 per month, which means that's our max housing expense if we make $75,000 a year. But in this example, you could also have $625 in monthly debt, whether it's car payments, credit cards, a combination of the two, and still qualify for that same home because 57% of $6,250 is $3,562, which would be our max back-end ratio. And then when it comes to the $100,000 salary, that breaks down to $8,333 a month, which means our max housing expense would be $3,916 if we were pushing it all the way up to that 47%. And with that, we could have $834 in monthly debt and still qualify for the same home because our back-end ratio of 57% is $4,750. Now, I think it's important to note, not everyone is going to be able to go all the way up to a 57% back-end ratio. It's going to take some compensating factors, things like good credit, things like, maybe some money in the bank outside of your down payment and your closing costs. Now, while FHA only requires a 3.5% down payment, that doesn't necessarily mean everybody's going to be able to qualify with 3.5% down. Some people might need a little bit more money down in order to qualify for that loan. That's just the bare minimum qualifications. And with that, you need a 580 credit score. Now, one nice thing about FHA is that if you have below a 580 credit score, you can still qualify for an FHA loan. You just need a larger down payment. You need at least 10% down if your credit is below 580. But here's what I'll say. From experience, it's very difficult to get qualified for an FHA loan if you have less than a 580 credit score. So if I were in that position, what I would do is I would focus on improving my credit, trying to get my credit higher because the terms are going to be better all the way around. You're going to get a better interest rate. You're going to be able to get a lower monthly mortgage payment. In turn, you're going to be able to qualify for more home with better credit. So your credit is the most important piece of the puzzle. So rather than just trying to skate by with the minimums, what I would do is try to work on that credit score so that you can get the best terms out there. So now that we understand salaries and how they work, let's take a minute here and understand how the mortgage payment works so that you understand everything that's factored into it when that lender is trying to qualify you to buy a home. So the very first thing we're going to do is take your purchase price, right? Let's just take, for example, a $350,000 purchase price. Now, with FHA, that requires a 3.5% down payment, which is going to be $12,250, which gives you a base loan amount. But here's one thing about FHA that's different than other loan programs out there, that's different than conventional loan, is they have something called an upfront mortgage insurance premium, which is 1.75% of that base loan amount that we just discussed, because that's $350,000 minus the down payment of $12,250 gives you that base loan amount, $337,750. Now, how that upfront mortgage insurance premium works is they take 1.75%, they multiply it by that number, which gives you the upfront mortgage insurance premium amount. You add it back to that base loan amount. So in this case, it's $5,911. You add it back to that base loan amount of $337,750, which gives you an amount that you're financing of $343,661. Now, on FHA loans, that upfront mortgage insurance premium is required on every single loan. Regardless of your credit score, regardless of your down payment, you're going to have it. And honestly, that's one of the big downsides of using FHA, is because you're giving up essentially half of your down payment towards that upfront mortgage insurance premium when you're buying using an FHA loan. Now, the upside is that it allows you to buy a home with lower credit scores, with lower down payment, whereas otherwise you might have to wait in order to build a bigger down payment in order to qualify for a home. So in my opinion, it's just the cost of doing business. Now, there are people out there that will say it's bad, you shouldn't use it, you shouldn't give away half of your down payment. But here's the thing, I've seen many people buy using an FHA loan, and over a short period of time, they've been able to refinance out of that into a conventional loan because the equity has been built in that property, and they wouldn't have been able to buy a home otherwise. If they had waited until they had that larger down payment where they would have avoided that upfront mortgage insurance premium, they probably still wouldn't be a homeowner today. So while it's not ideal, it does allow you to buy a home where you otherwise might not be able to do it. So that's essentially how we're getting the loan amount that we're using when we're using an FHA loan. We're going to be basing everything off of that $343,661. Now, our numbers are going to change here in a minute, but I'm just trying to give you some general calculations so that you know when we're talking about your interest rate, that interest rate is going to be based off that loan amount in order to determine the monthly mortgage payment. Your property taxes are going to be based off the purchase price, right? But you also have something called your monthly mortgage insurance. This is required on every single FHA loan. When you're putting 3.5% down, it's 0.55% of that base loan amount divided by 12 is going to give you your monthly mortgage insurance. Now, with FHA, it's required on every single loan, regardless of whether you put 20% down or not, right? Mortgage insurance is there to protect the lender in case you default on the loan. Now, with conventional loans, when you put 20% down, you don't have monthly mortgage insurance. But unfortunately, when you're financing with FHA, you do have that mortgage insurance. And that mortgage insurance is going to stay on that loan for the life of the loan when you put 3.5% down. Now, if you're fortunate enough to have 10% and go FHA, that monthly mortgage insurance will fall off after year 11. But for most people using FHA, they're going to use the 3.5% down option, which means it's going to be on there as long as you have that FHA loan. Now, if you build equity in the property and refinance out of that FHA loan into a conventional loan, you can get rid of that mortgage insurance. So assuming you have that FHA loan and over time you build equity, you pay down the balance, you have some equity in that property, and now, maybe interest rates come down, maybe you're in a position to refinance into a conventional loan, maybe lower your monthly mortgage payment, get rid of that monthly mortgage insurance, and you're in a much better position. So now that we understand a little bit about FHA loans and how to calculate income, how to calculate debt to income ratio, how to calculate that monthly mortgage payment, let's take a look here and see how much home you could qualify if you made a $50,000 income per year. Remember, the most we can use on a mortgage payment is $1,958 in order to stay at 47% of that monthly income of $4,167. So in order to calculate these numbers, we're going to be using an interest rate today of 5.75%. That's essentially where FHA loans are today. So we're going to be using 5.75%. We're going to be using 1.1% for the property taxes because that's the nationwide average. Here in California, where I am, it's about 1.1%, so that's accurate. But there's states like Florida, states like Texas, states like New York, where property taxes are high. They could be as high as 2.5%. So if you're in one of those states, the calculations are probably going to be off. You're going to need to factor in a higher property tax amount and do some different calculations. So you might be able to qualify for less home than we're discussing here today. So that's why it's important to know, your local amounts. And if you don't, talk to a lender in your area. Our team helps people all over the US, so we can help you too, regardless of where you are. So make sure you reach out using that link in the description. But for a $260,000 home, that's where we're gonna start today. That's gonna require a down payment of $9,100. And then once we factor in that 1.75% upfront mortgage insurance premium of $4,391, that means we're financing $255,291. And as I said, we're gonna be using an interest rate of 5.75%, which is gonna give us a monthly mortgage payment of $1,490 per month. On top of that, our property taxes are going to be $238 a month. Our monthly mortgage insurance is going to be $117 a month. Remember, that's 0.55% divided by 12 of that $255,291. And then on top of that, you're going to have monthly insurance, which is going to cover fire, theft, that sort of thing. And on a $260,000 home, it's probably going to be about $100 per month. So all of those things added together is going to give you a monthly mortgage payment, a total monthly mortgage payment of $1,945, which is just under that $1,958 that we mentioned at the beginning of the video. So if you make $50,000 a year, you're essentially capped out at a $260,000 purchase price with about $417 in monthly debt. Now, when it comes to that $75,000 income, you're going to be maxed out somewhere around $400,000 because that's going to break down to a payment of $2,939. And if you remember earlier, 47% of that $6,250 monthly income that we were using was $2,937. So you're right there in line with that max front end ratio on a $400,000 purchase price. But with that, I want to take a minute here and break it down. On a $400,000 purchase price, you're putting $14,000 down. That's 3.5%, which is going to give you a loan amount of $386,000. But we have to add back that 1.75% upfront mortgage insurance premium, which is going to be $6,755, which means you're going to have a base loan amount of $392,755. We're going to take that, we're going to multiply it by 5.75% to figure out our monthly mortgage payment, which is going to be $2,292. And then we're going to add our property taxes on top of that at 1.1% of the purchase price of $400,000, which is going to be $367 a month. And lastly, we have the monthly mortgage insurance, which is going to be $180. And we're also going to assume our property insurance is about $100 a month, give or take here, which is going to give us a total monthly mortgage payment of $2,939. Now, a moment ago, I said our homeowner's insurance was roughly $100. This is another thing that's going to vary tremendously depending on where you are in the country. If you're in an area of the country that's prone to not a lot of natural disasters, say you're in a high fire area, or you're in the Gulf of Florida where, hurricanes and that sort of thing happen often, or maybe you're in the middle of the Midwest, right, where there's tornadoes and that sort of thing, and you get them often, property insurance is probably going to be higher in those areas. So it's important that when you're going through this process that you talk to one of those people, get a quote so that you have a realistic number. I can estimate on this side just based on what I see, but it's important that you actually speak to a professional, go through the real numbers so that when you are pre-approved and you're out there shopping, you kind of have an idea of where you stand. And that's why I think it's super, super important to go to a mortgage professional. Don't just run these numbers on your own. Have them look at your income. Have them look at, your credit scores. Factor all of this stuff in so that you're actually pre-approved to go buy a home. What I often see is people just calling somebody and having a conversation on the phone and saying, hey, I make this a year, this is my credit score. And then that lender says, okay, based on that, this is how much you can buy. But they never ran any numbers. They never actually saw the pay stubs. They never actually saw the tax returns, the credit scores. Right? If you're not providing any documentation, that's just a pre-qualification. You can't buy a house based off a pre-qualification. You can buy a house based off a pre-approval where they're actually looking at the documentation. It's super, super important. So when you're going through this process, talk to a professional. If you're not sure where to start, again, we help a lot of people here on YouTube. We have a list of 5-star reviews of people that we've helped here on YouTube, and we'd love to help you. Just use that link in the description of the video. So now we've talked about $50,000 of income. We've talked about $75,000 of income. How much home can you actually afford with a $100,000 income? It's going to be somewhere around $530,000 because that total monthly mortgage payment at $530,000 is $3,911, which is $5 better than our max of $3,916, which was 47% of that $8,333 monthly income. That would also allow you to have about $840 in monthly debt and also qualify for that home. But how it breaks down, you got a $530,000 purchase price. You take 3.5% of that, which is $18,550, which is going to give you a loan amount of $511,450. We have to add back that upfront mortgage insurance premium of $8,950 because that's 1.75% of that loan amount, which means you're actually going to be financing $520,400. And that's going to give you a monthly mortgage payment of $3,037. On top of that, you're going to have property taxes, which is going to be $486 a month. And then you have that monthly mortgage insurance premium, which is going to be roughly $239 a month. And then you're going to have homeowners insurance, which again, estimating somewhere around $150, which is going to give you a total monthly mortgage payment of $3,911. So now that you've seen $50,000, $75,000, and $100,000 of income, where do you sit? Are you closer to the $260,000 purchase price, the $400,000 purchase price, or the $530,000 purchase price? Let me know in the comments. Now in today's video, I went over a lot about FHA loans, but there's a lot of things I didn't discuss when it comes to employment, when it comes to income. So if you're curious about that and wondering if you can qualify for an FHA loan, do me a favor and check out this video here.